Hi, this is Richard Vague with Tycos. In this new age of AI, technology stocks, both those publicly held and privately held, have reached new heights in valuation. In July alone, both Nvidia and Microsoft crossed the $4 trillion market cap milestone. The question is, will the stock market crash, and within that, will tech stocks crater? The answer is, of course they will. As we have seen in the broader stock market, corrections of 10 to 20% are common, and recoveries from these corrections usually take no more than a year or two. So the better question is, will the tech stock correction be in that 10 to 20% range, or will it be much steeper, as in the 2001 Internet 1.0 crash that took the Nasdaq down by 75% and took 14 years to recover from? Not to mention the steep stock market crash in the global financial crisis of '08. For us, a clue comes from debt, specifically comparing the debt levels that existed in 2001 and 2007 to those of today in three areas: tech industry debt, margin debt, and a new entry, crypto debt. First, let's look at valuation. The technology-heavy Nasdaq is trading at a trailing 12-month PE of 35.6, the highest since December of 2020, but it's nowhere near the level of 68.9 from 2002. Earnings were fairly anemic in the stocks of that day, is one of the contributors to that PE. And please note that there are more privately held large tech companies today than then, so less publicly held, relatively speaking. However, by two other important measures, the comparison of Nasdaq market cap to GDP, which is the same thing as saying comparison of Nasdaq market cap to total income, and also the comparison of that market cap to M2, which is a proxy for debt. It's the money supply. We can see in both of those situations that valuations are at or near an all-time high. Nasdaq market cap to GDP is at 118%, as compared to a comparatively mild 54% before the Internet 1.0 crash. And Nasdaq market cap to M2 is 160%, as compared to 112% just before Internet 1.0. As long as we're talking stock market valuations, let's look at the total stock market, tech stocks included. The total market PE is 20, which is higher than the level of 16 before the GFC, but below the level of 24 just before the Internet 1.0 crash. And total market cap is now 241% of GDP, much higher than the 130% level before the global financial crisis, and also well above the level of 168% before the Internet 1.0 crash. And finally, total market cap to M2 is 326%, well above the 252% level pre-GFC, and almost as high as the 347% level pre-Internet 1.0 crash. So let there be no question that stocks, whether tech stocks or all stocks, are very highly valued and highly susceptible to a correction. But let's look one level deeper. Let's look at the amount of debt that has been employed to purchase stocks, margin debt, since that is one of the key measures of the vulnerability of stock prices. If more debt, especially margin debt, has been used to buy stocks, then the more fragile that market is, for the simple reason that stocks will have to be sold to pay down that margin debt in a declining market. So now let's compare those debt levels in these three periods: the Internet 1.0 period of 2001, the GFC period of 2007, and today, 2005. And let's do that for total debt, tech sector debt, and margin debt, each in ratio to GDP. As mentioned, total debt to GDP is well above these two previous periods. And tech industry debt is also higher than in previous periods. And we are hearing more and more about creative financing in this area, such as loans secured by AI chips to enable greater company expenditures in the AI race, something that seems like a higher form of risk, at least to us. Note that while the current level is higher, we have not had as sharp a run-up as in these previous periods. That gives us at least some comfort. And lastly, we can see that margin debt is at a higher level than at any time in the last 50 years. That's the leverage you use when you buy stocks from your broker. And you can also see there's been a sharp recent run-up in that amount. So you can see that for each of these, debt levels are actually higher than in these prior two periods. And history shows us that stock market corrections that are accompanied by a debt crisis or a debt over leveraging are felt more and take longer to recover than those that are not. As I mentioned earlier, there is another area of debt that we at Tycos will continue to monitor, and that is cryptocurrency debt. Our estimates place global crypto debt at approximately $126 billion, or 0.12% of global GDP. And while in the grand scheme of things, these numbers are still very small, and we don't feel really factor that much into the equation yet, the rapid expansion in recent years is a cause for concern and a reason for us to keep our eye on that. So, all those factors together lead us to the belief that a tech stock correction now could be somewhat deeper and last some amount longer than the corrections of the last 10 to 15 years. So, stocks are vulnerable. Add to that the wild card of tariffs, which, if high enough, will make a big dent in U.S. corporate earnings, and it underscores that vulnerability. We're not saying that this will happen tomorrow or even in coming months, though it could. But it would be unreasonable not to expect it at some point in time over the next year or two. That's it for this week. Thanks.